Good morning, ladies and gentlemen, and welcome to the KINOVO PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They could be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it is appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from KINOVO PLC. David, good morning, sir.
Good morning, and good morning to everybody. Thank you for taking the time to dial in today to hear our results presentation with respect to the period ending 30th of September. With respect to the agenda, we will go through the financial highlights, the operational highlights, close off where we are in terms of discontinued operations. Obviously, there'll be a financial summary that Clive will run through from the business in the first half. We'll go into a little bit of detail to provide some of the implications of the Chancellor's budget impact, and then focus in terms of the continued delivery of our growth strategy and various elements that underpin that, followed by the outlook. So if we start off with financial highlights, I'll pass over to Clive. Most of you are aware of, obviously, Clive. For newcomers, Clive Lovett, Group FD.
Thank you, David. Good morning, everybody. I'll zip through this slide fairly quickly. We have some further slides that adds a little bit more colour into to some of these numbers and the analysis. But overall, we saw a fairly flat H1 in terms of revenues. There are some underlying reasons for that, which we'll go into in a little bit more detail. But as you'll see from the slide, it's principally relating to a contract we have with a client, which is Hackney, and really more of a timing difference there. Below that, we saw a fairly robust set of results with gross profit up 8%. And this is primarily driven, and we'll go again into a little bit more detail on the drivers to this, but by our electrical services division. A very strong first half for that, and that is higher margin, so it's actually driven an uplift in the profits in that period. And that really drives down through the rest of the P&L with EBITDA, operating profit, adjusted PBT, all up around about 10%. So a double-digit increase year on year, which we are very comfortable with for that period. Earnings per share up 7%, so comparable, a few other adjusting areas in there. In terms of cash, a solid cash conversion, actually. I mean, 106% for the underlying business in that period is very strong. A little bit of seasonality really in there. I'm looking at it sort of more on a longer period of time rather than just that 6-month period. So over 12/18 months, it actually works out around about sort of low 90s, about 94-92% for those periods. And that's more in line with what we kind of see and expect to achieve over a longer period of time, and probably what we are more in line with expectation for the full year. Net debt has actually gone from a net cash position to a net debt position, movement of about 1.3 million in the period, driven by mainly two things, which again we'll both come back to. Some deferred VAT payments that we made in the period, and the DCB cash outflow. In terms of our visible revenues, which is our interpretation of an order book, but not not a contracted order book. It's more based on run rates and expectations, as well as underlying contractual values. That's gone up 12% year on year, but also it's gone up 8%, which is equivalent to just under 13 million since the year end. So pleased to kind of see that coming through, driven by some underlying increases in our existing client base in terms of some of the volumes of work that are coming through and the run rates that we're seeing, together with the new business contracts that we've seen starting to come on stream. Not an enormous amount of those new contracts in terms of revenues in H1, but we are starting to see those now mobilise and come through in H2 and then beyond.
Moving on to the operational highlights, we've emphasised the favourable mix of works and operational efficiencies, delivering increased gross margins, a little more commerciality in our mindset, and as we say, driving that productivity piece as we've historically committed to. An example of that is no access rates that we've highlighted with respect to some software that we implemented across the piece to improve that communication and that service piece between resident and our engineers. Overall, that run rate of no access reductions has continued around the 40% mark, and indeed we do actually have a contract where it's reduced no accesses by 50%. So on one side, we save the wasted journey, the wasted costs associated with knocking on the door when no one's there, and more importantly, then we can deploy that to a revenue generating scheme or visit, should we say, with respect to those operational efficiencies. So strong positives on there. Clive alluded to the revenues being slightly backwards. If we look into that in a little more detail, just to highlight, some of you will be aware that we exited a private sector mechanical contract last year. So that contributed to circa 915,000 of revenues in that first half. And that delayed issue of the Hackney contract, which Lee will go into more detail shortly, which was a net difference on that being circa 4.4. So if you strip those two elements out, underlying growth on revenues was 18% on a like-for-like basis for the business. Clive alluded to the strength of electrical services in terms of that total revenues, accounting for 63% of our total pie in that first half of the year. Undoubtedly, this reflects back to what we've highlighted previously with regards to the implementation of the Building Safety Act. 1st of April this year, the social housing regulator has now provided HSE as their exam checker with respect to compliance. This dates back, as we know, to Grenfell. And whilst there is a lot of focus on cladding, of course, Grenfell was initiated sadly by an electrical fire. So this, in terms of the electrical side, goes into smoke alarms, fire alarms, as well as the standard electrical checks and remedial works. With respect to remedial works, we can see regulation continues to be their foundation. Again, strong attributable revenues of 57%, which is driven by these legislation requirements. A slight drop from the 61% last year, but that's because the remedial works associated with these compliance checks have gone up, which sits in our regeneration pillar, and that's increased to 33% over the period. Renewables have been down. One of the drivers on that, as the previously mentioned, private sector contract exit. Alongside that, some of the delays in the planned works, and certainly a lag on some of the SHDF works that we are undertaking. We've previously mentioned, with respect to the SHDF works, the process that is required to undertake that. In particular, you do an initial assessment. We'll then follow that up with a survey. The survey will come up with measures. The measures will go into the client. The clients will decide which of these measures they want to prioritize to get to a C. This comes back to us. We price it. This goes back to client. Then we're in action. A lot of this has been absorbed in H1, and therefore we can now see the action, should we say, start to come through with respect to these in H2. From a strategic investment perspective across the business, we continue to obviously invest in our teams and our capabilities. There's been elements of this in terms of the business development and renewables teams, some strong gains in terms of that recruitment there, which will play into our hands, obviously, as we continue to focus on the organic growth strategy and driving that pipeline of visible revenues in terms of that growth outlook. From discontinued operations, I'll pass over to Lee Venables, COO.
Good morning, everyone. So I am actually now pleased to say that the 9 projects as part of that discontinued operation are now all build complete. They are now all warranty sign off, and the pictures on the slide there will show you the final one that is on site, of which we are just in the middle of completing the variations that are an addition to the contract on that final sign off. As part of that process to get us to this point, you'll see, and I think we spoke previously about the 2.2 million that we'd agreed on the penultimate project, and we've paid the 3 bigger payments, which total the 860, and that has allowed us to diffuse the performance bond that was on that. And then over the remaining 15 months, we'll pay around about 80 to 90k, so a much smaller amount, and allow us to manage that through the cash flow. What that does mean then that the pre-tax costs to complete all these projects will remain unchanged, as we said at year end, and 12.9 million before recoveries. As part of those recoveries, we've got a number of elements ongoing in regards to that. We've been successful on a couple, but there is a number of larger ones in regards to variations, loss and expense claims, and some smaller ones in regards to the subcontractors that have undertaken some of the works. On that subcontractor stuff, we need to be very diligent in which ones we do or don't do, because we don't want to be throwing good money after bad on some of the claims where some of these smaller subcontractors won't have the funds to pay us back. In regards to what's remaining, the defects liability period, which some may be aware or not aware, so once that project is practically complete, we enter the year's defects period. At year end 25, we will only have 2 remaining projects that will be left in defects period. One of the 2 will close out in May, and the final one is in relation to the project that you can see on the screen, which will go into the back end of next year.
So just got 3 slides really just to effectively summarize what we've already covered. In terms of revenues, David has spoken around, sort of the moving parts within there and the impact of the British Gas and Hackney in terms of the timing that has just held back, I think, the growth that's reported, but underlying, we've seen some good positive, sort of direction of travel on that. With good operating margins, generally with electrical certainly driving the way and driving the half-year profit. As you can see there, as I referenced previously, sort of 9-10% uplift in most of the sort of the key performance indicators. Comes on in the next slide on cash, but just to emphasise that the movement in the taxation charge there is more just on a deferred tax basis, so a non-cash deferred tax charge rather than any reference to tax payments. So we are not expecting any tax payments in FY25, but we do expect that to come back in as we've utilised the brought forward tax losses into future periods. As we see, EPS at the bottom, which is up 7%, which is a key performance indicator. If I really go down to the bottom line, the total basic EPS is up 31%, which more than anything just sort of emphasises that we haven't seen and not expecting an uplift in, and therefore no P&L effect on the discontinued DCB costs. From a cash perspective, again, I've referenced some of these things before, but just really to pick out a few things in there. Good cash conversion over 12 months, so 94%, which is a more normalised period for us. Just in the middle there is a movement in working capital and the adjustment for the deferred HMRC payments. So actually net those two with each other. So we've actually seen an overall, excluding the HMRC payments, benefit of a couple of 100,000 in working capital, and that's what's driven the over 100% cash conversion in the period. Just on the HMRC payments, that was a deferment that we had, and we deferred VAT, which I think we've been through on previous presentations, certainly for the year end. That we deferred it at the year end, and we had a payment plan in place with HMRC to repay the 1.3 million that had been deferred over the first 6 months of this financial period, which has been completed, was completed within those payment plan, and is now back to a normalized position. So the only other thing really to mention that we see coming into H2, and again something that we've referenced previously, is that we have a purchasing card, and the terms on that purchasing card, effectively due to underlying economic drivers, principally the increase in interest rates over the last couple of years, is a rebalancing of the payment terms that we have on that and the credit terms that we have, which will have a cash impact of 1.4 million in H2. No corporation tax payments, as I said, in the period, but we are expecting that to come back. So just really to summarize that out in terms of that net debt position and that movement, 1.3 million, as I previously referenced. We've got 1.3 million outflow on HMRC payments and 3.2 million outflow in the period on DCB, and that's set off by the cash inflow from the underlying business. We do expect that in H2 that the DCB position will be fairly neutral in terms of cash, maybe a slight cash outflow, but certainly that's the expectation that we'll see that as pretty much broadly neutral in that respect, and that enables us to then utilize the cash internally rather than it going to DCB and financing those projects. And we are expecting, and we'll see that through the analyst note that's produced by the broker, that at the end of this financial year, we're expecting the cash position, or at least the broker has a cash position of about 1.2 million positive at the end of this financial year. That does include an element of DCB recoveries in there of about £1 million. So I think that what we're seeing, that even if there's no DCB recoveries that come in, and we are confident in terms of the strength of the claims that we have, that we're talking about break even plus. If we actually look forward into the forecast that the brokers have for the end of FY26, the analyst for the brokers we're looking at a cash balance of around about 7.4 million. Again, that includes the DCB recoveries. So even without anything, we're looking at the end of FY26, probably around about 5 million plus, depending on the DCB recoveries that come in. So just to give you a flavour of now where we're moving to with the completion of the DCP projects. There is some cash outflow still to come, as we said, on the settlement. That's fine. And this final is really just to show that movement. I'm very much emphasising that the recoveries that we get and the cash that we get from the underlying business has historically been set off by the DCB impact, and in the period there was the deferred HMRC. Those two big red blocks there, we're expecting to be normalised to being a marginal impact, and therefore we can then start utilising the cash that's generated by the underlying business internally within the business.
Thanks, Clive. Moving then from that backward-looking piece now to where we are and moving forward, we thought it'd be beneficial to obviously provide a slide on the Chancellor's budget impact and the implications that has to the business. A lot of focus, obviously, from businesses with respect to these national insurance changes and national living wage changes, and obviously we're not immune to that either. If we look at what the outlook of this impact is in terms of the increase in the employer's NI to 15%, the reduction in the NI threshold, as well as the increase in the national living wage, we expect to have that at an impact of circa 500,000 or up to 500,000 on the business. That's part and parcel of the bad news, should we say. If we're switching to the good news in terms of the trajectory of the business and the direction of our travel, we believe we will be able to mitigate that impact next year through our growth in the business. Moving further into then the other side of the budget, which we are fortunate in terms of the arena that we work in, the sector that we're in, to have a positive side to that, is that the Chancellor is committed to an additional 3.8 billion over the next 3 years for the Warm Homes Plan. This fundamentally relates to the Social Housing Decarbonisation Fund. We've been successful on a number of these awards and projects that we previously mentioned, and expect that to continue. So the opportunity for this further funding certainly plays into our hands from that focus perspective. And indeed, I was speaking to Lee today. There is Wave 3. We talked previously about Wave 2.1. Wave 3 is due to be announced in March for SHDF funding. And we believe that the local councils and authorities have put in a request for 2.2 billion already with regards to Wave 3. Moving further down the sort of positive list in that regard, 1 billion additional for building safety remediation and social housing. This veers on from what I mentioned earlier with respect to the Building Safety Act and the beneficial downflows into the electrical services business, because not only does it cover wiring, as I mentioned, it covers smokes, fire alarms, fuse boxes, arc fault detection devices, lightning protection, a raft of measures sitting under that electrical services unit. 500 million for the Affordable Homes Programme, and then finally a proposed new 5-year social rent settlement at CPI plus 1%. I think some of the housing authorities would try and prefer a 10-year scheme, but even with 5 years, it provides some perspective for them in terms of obviously future cash flow and budgeting and investment management. So a tale of two halves in terms of the budget for us. Negative being NI, impact of 500,000, but we expect to mitigate that, taking into consideration our momentum, and then the massive upside in terms of the opportunity. Devil will be in the detail, and I'll believe it when we see it getting rolled out, but certainly that offers promise for us moving forward. Moving on from that, and being part and parcel of that, I think we wanted to put some basic stats up, which not only, I think, validates the strength of our organic growth strategy, and with that, the 3 strategic pillars of regulation, regeneration, and renewables. I think this also helps to demonstrate some of the growth potential underlying that's sitting in the market. And this is wrapped under these compliance and decarbonisation focus as sort of key drivers in our sector. This will continue to be the case very much so for the foreseeable future. On the left-hand side, put some stats up with regards to housing stock. I have mentioned this previously, so an element of a repetition, but the issue hasn't gone away. In the UK, the housing stock is definitely the oldest in terms of Europe, if not the world, particularly when we look into the London sector. So a lot of aging properties that require some love and support, and with that flowing down to the EPC ratings, a fundamental baseline of achievement on EPC in terms of energy performance certificates is a C. Anything below, i.e. D downwards, is the objective is to move that to the C, and that's the driver for councils and local authorities. So plenty to do from that sort of decarb retrofit side alongside it. Flipping us across the other side to homelessness and targeting our key areas. This has been a significant drain for local authorities. Some shocking statistics: 1 in 53 Londoners affected by homelessness, and 59% of England's temporary accommodation placements located in London. The waiting times for some of these homes, as for an example, a family-sized home, can be up to 6 years. Frightening statistics, a drain on councils' budgets, but I highlight this with respect to the fact that the promise of additional new homes is one thing from a government's commitment, but that is not a short, even medium-term fix. They need to address won the properties that they've got, and alongside that, I've put in the bottom there the number of void properties that are available. These are long-term empty homes. There's 38,000 in London alone, 36,000 in the southeast. All these are, like I said, sad statistics, but through these statistics offer an opportunity for the business to work with our partners to resolve. And as I said, these market drivers are not going away. Compliance will continue to strengthen. The power of tenants to landlords will continue to strengthen. And with that, therefore, the requirement for regulation is only going to increase. Similarly, in terms of properties and that movement to net zero, I do not think the new government is any less enthusiastic in terms of driving to net zero. And I think indeed that drive will step up. And this will dominate us as macro factors to drive our business over the short term. If we now move on in terms of other drivers, obviously with our organic growth strategy, it is fundamental for us to get that pipeline full and get that pipeline moving. As we've mentioned, we've continued to invest in that business development team further, and therefore are very confident in terms of our outlook in that regard. I'll pass back to Lee to give you a bit of feel and flavour of how that pipeline has evolved over the first 6 months.
Thanks, David. I think we touched at the outset on that 4.4 impact from the Hackney contract. Fundamentally, a contract that we had that we was unsuccessful in renewing. Impact of about circa 6 million across this financial year. But what that did lead to was ongoing discussions, and we was aware that Hackney had this SHDF funding, that we was in a real strong position on a framework, and this resulted in a direct award for us of this 12 million on this SHDF funding. The second part of that, and you'll see a second contract there, award. The original contract that I talk about that we had was decoupled. So although we was unsuccessful in that lot 1A, the ongoing decoupling of that has resulted in us winning the lot 2A. I think previously we put an RNS out about the award of the 12 million on the Hackney SHDF funding. We said in regards to that lot 2A contract that it was around about 400k per annum. In seeing the contracts, that has actually been upgraded to 750 per annum, so it will give us 1.5 million across 2 years, and there is an option to extend for a further year. We are seeing, as part of that decoupling of our original contract from last year, that there is additional lots coming out. We know there's a lot 3A, 3B out, which we are currently in the middle of tendering, and I expect to see further awards as they come out of Hackney on their lots 4, 5 and 6 as it gets further decoupled. You'll see on the bottom around the Eastern procurement. Eastern procurement is fundamentally in and around our Durham and Norfolk region. So these two frameworks that we have engaged on is just strengthening that position, and will help us on that direct award from around the Norfolk region. If I move on, I mean, you'll notice on this slide the amount of new clients that we signal on the right-hand side of the slide. That's real evidence that we continue to diversify our client base. You know, historically, we've been very much focused on same clients and just renewing tenders. You'll see now, and we talked about the investment in the business development team. This is really starting to bear fruit on the new clients and the diversification of those areas. The top one, the North River Alliance, is in fact a organisation that is built up of 9 individual housing associations, and again is further evidence of this SHDF funding that is available. You know, we've seen the Hackney one, there's the North River Alliance. As you work down, RHP, you'll know, now RHP is also a client of ours on DCB. And again, that was a direct award through the National Housing Maintenance Forum framework that we was on, as was the A2 Dominion. The bottom one is a contract with Newham, 10-year contract, but it's built up of 1 year plus 9 incremental 1-year contracts after. Starting off at a relatively low value of 80k, but this is kind of evidence of some of these where once we get in and we do this testing in relation to the Building Safety Act, that we can start to see some of these value grow. And in fact, although we started this contract at the back end of October, we have already been asked to undertake an additional 900 properties within that. So great diversification of clients, some real big SHDF wins within there, and shows some of the futures bright moving forward. We are seeing currently that this period is extremely busy within that new business and tendering element. I think one or two reasons why, mainly around we're coming up to Christmas, so the organisations want to get them out before that. And also we've got the new Procurement Act that has been pushed out to February now, where KPIs will be in the public domain, and both contractors and clients will need to show those stats publicly. If I move on quickly to social value, I mean, social value is and will continue to be at the heart of what we do as an organisation. We're seeing social value really as a bit of a soft marketing type business opportunity. You know, we attend lots of these social value events now, and you see that the persona on that has gone up a level with the execs attending now from all of the local authorities, housing associations. So we get to mingle with the execs from the local authorities. There's some examples on there of some of the work that we've undertaken. I mean, there's a Peabody cleanup, but I want to draw your attention to the visual front and centre. So that's Pippa Pang. She's our social value head of marketing and social value, and Pippa has moved mountains for us as an organisation and has made great strides. You know, as an organisation, we're not a tier 1 business that have the luxury of having multiple people within a team. You know, Pippa originally started this on her own, supported by every member of the organisation on attending events or undertaking tasks from a social value perspective. And I'm pleased to say that Pippa's been nominated by one of our bigger clients, Hyde Housing, as the best social value leader. And I think the awards are this evening. So we'll feedback on Pippa's success. Alongside that, Purdy have also been nominated for Social Value Excellence. So it's a real testament to the work that's being undertaken by the organisation and by Pippa. Pippa's expanded her team over the last sort of 6 months, and we now have a social value lead within Purdy and within Spokemead and within Dunhams. And you can't underestimate the importance of the social value element and what we can give back to not just our clients, but the residents that live within the areas that we work. So it's a really important piece of work for us to continue undertaking.
Thank you, Dave. So to summarise the presentation and where we are in terms of our outlook, as I've said earlier, the macro drivers for the market and the sector in terms of compliance and decarbonisation will continue to drive potential for the foreseeable future. With that, as I've mentioned earlier, I think this not only validates part and parcel of our organic growth strategy, but it also underpins the strength of our strategic pillars in terms of regulation, regeneration and renewables. Continue to strengthen our position and strengthen our position as a one-stop shop as well. As we've mentioned in terms of SHDF previously, and this is part of where that mix of works play comes into our outlook, is when we're undertaking those surveys for decarbs, and there is a list of options in terms of the council authorities. It could go mechanical, it could go electrical, it could go building services. we have the end-to-end solution with regards to that delivery. So positive in terms of the market tailwinds, positive in terms of the strategic positioning, and it's down to ongoing execution. Revenues will be expected to pick up further in the second half of the year, not least because of our traditional heavier second half weighting anyway. As we know, we tend to build up from Q3 into Q4 as winter arrives, and then we move into the back end of the year that are synchronous with our clients in terms of a budget year end. Interim is continuing to gather momentum. Obviously, this is our sort of pilot office in Norfolk. We've gone from a nil start to delivering 450 in terms of the first half of the year, and momentum continues to gather pace there as we settle in a new office in a new geography with new staff, new clients, new processes. We're making positive headway in that regard, and expect momentum to continue. Lee's mentioned obviously now that deferred element in terms of that first half of year from the Hackney tender is now come through, and we're undertaking surveys and assessments now on the SHDF side. On the reactive repair side, again, that is expected to start with immediate effect and is now underway. And that whole perspective actually gives us a double opportunity from where we were with Hackney to where we are now, with further opportunity ahead. So we're very positive in that regard. We've noticed, Q2 for us, and I think in general in business, was sluggish, unusually sluggish for us. Whether this was recognition within councils, local authorities of the incoming change in government, whether this was part of the apprehension of waiting for the budget, but we did notice Q2 was somewhat sluggish for us. Q3 has definitely turned that corner, and with that we've started to see some of these delayed planned works as well now getting signed off and in action. So the second half bodes very positively for us. With respect to the discontinued operations, as both Lee and Clive have alluded to, we're pleased to be seeing the real end of this now, and with minimal cash outflow in terms of H2 in relation to that. One, the money comes back to the business, and two, we all remain focused now on that front footing rather than the rear viewing. So with that in mind, and with it, the sort of tailwinds in mind, the board are very much confident in terms of the momentum that we've achieved in H1 will continue for the remainder of the full year, and obviously have mentioned that we expect to be moderately ahead of the board's previous expectations for the full year. That momentum doesn't reduce in any way, and indeed the confidence in that momentum is such that whilst we've highlighted the impact or the potential impact of the Chancellor's NI and National Living Wage uplifts, that we will be able to mitigate that in the following year through additional growth. So we'll obviously be opening up to questions, but we're in a good position. We're looking forward to the year end. We're looking forward to striving ahead, and the team are all motivated to do so. So off the back of that, I thank you for tuning in. Obviously there'll be Q's and A's to follow, and we look forward to updating you again moving forward.
Perfect. David, Clive, Lee, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Guys, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions and give your responses where it's appropriate to do so, and if I pick up from you at the end, that'd be great. Thank you.
Thank you. There was one pre-submitted question that we've just seen here. It consists of 5 parts. There was actually 5 questions, but we will go through these one by one. The first part with respect to this submission is, I assume there'll be no further DCB costs booked in the income statement in H2 25? Question mark, Clive.
That's our expectation. With the projects being almost completed now, that's our expectation. I mean, the potential is for that number to go down depending on the recoveries that we achieve, which is actually part two question of this is can we reach the 2.6 million that we've previously referenced and have referenced in the interim statement as well. And the answer to that is we believe that we can. I mean, they have to go through some pretty robust preparation and legal considerations, but they are, and we are significantly underway in that. Lee outlined that we've been successful in 2 adjudications, the first 2 that we've undertaken. So we have a number of others in the pipeline. The outcome of that is to be decided, and that's not in our gift. In our gift is to provide a robust and strong claim, but we have to determine and see how that turns out. Again, I think Lee mentioned that some elements of that will be slightly slower burn in terms of potential recoveries on it, particularly around the assessment of the subcontractor elements of the claim. But from our perspective, we are still aiming for that as a figure.
Thank you, Clive. So you covered the second question as well with respect to that then. Third question being, can deferred tax assets be utilised in such a way that FY25 taxes are in practice 0?
Yes. So deferred taxes, I mean, it's non-cash. It's a movement on effectively on a balance sheet provision, and it's in place because of the tax losses, primarily the tax losses that we have in place. So and the availability of that deferred tax asset is dependent on an expectation that you're going to be able to utilise that tax losses. We absolutely do expect that will be the case. So it's more of a balance sheet stroke P&L balancing out, and deferred tax is really just there to be effectively providing a standard tax charge in the P&L, as long as you have an expectation that you can recover that asset, which again, as I say, is that utilisation of the losses. So yes, that is the case. I mean, in terms of how that then impacts is because from a separate position, which I think I did outline in terms of we have those tax losses brought forward, we are expecting to utilise them. That will mean that, well, certainly from a perspective of where we're at for FY25, there will be no tax payment. Once we do move into next financial year, which is based on the results of this financial year, FY25, we are going to have utilised those tax losses and will move into a tax payment position.
Question 4 of the same submission. Now that DCB is complete, can a dividend be paid late spring 2025? Question mark. Or better yet, buyback program be launched? Question mark. Clive?
Yeah. So I mean, I guess that's actually, I mean, I'll take that into a slightly broader context as well, and then revert back to the specifics of the question. So from our perspective as a board, this is a critical now look forward with the stabilisation and understanding of the final positions on DCB. This now becomes a critical and priority for us in terms of our capital allocation strategy. I mean, and we have a number of different options in there and a number of elements to assess on that. But firstly, you know, generally the organic growth investment, which is probably our priority as we have outlined and previously stated as well. Potential inorganic opportunities, not necessarily a priority, but if we see an opportunity there and be opportunistic, then that's a potential consideration. Bringing us to the 2 elements there that were referenced. Dividend and buybacks are certainly on the agenda for consideration. They are part of, I think, our capital allocation strategy. What we want to do is to ensure that we have the full flexibility to to pursue those strategies that we have. And in specific reference, what there won't be a dividend in late spring, I think was asked. And the reason for that is where we are at the moment is that we can't actually legally make a dividend payment because of the lack of distributable reserves that we have. So it is a focus for us in the first quarter of the new calendar year, so our quarter four, to be looking at some element of capital reconstruction that at least gives us the flexibility for the future to re-implement a dividend strategy. So I think that probably, and the same with buyback. I mean, I think that's certainly on the agenda of part of that capital allocation strategy.
Final part of this question then, Clive. I can't find the profit expectations board says they believe in. Could you perhaps repeat them again? Obviously, this is the analyst independent.
Yeah. So this is driven. There is an analyst note that is out there, as I alluded to earlier. That analyst note, which we are in alignment with, has got effectively an EBITDA for this financial year of 7.3 million. So that's up, as we say, moderately from 7.1 million. Year on year, though, that's not far off a 10% year on year uplift. So although we're just marginally moving it up with those tailwinds that David referenced, that's year on year is looking as a relatively strong uplift and sort of comparable to that H1 uplift that we were previously talking about as well. In terms of FY26, again, it's moved around a little bit because of the impact of the budget. So dare I say, it was that the analyst note originally were at 7.5. They did, but again, as I say, in alignment with our expectations as well. Take that down as when the budget was originally announced. We've then very moderately increased that up from 7.3 to 7.4. I think that what I should just reference there is that's after absorbing the up to £500,000 impact of NI. So on a kind of a like-for-like basis, from where it was originally at 7.5, it's more approaching, or would have been approaching, 7.98 million.
Okay, thanks, Clive. The next question is, can you provide more clarity on how you calculate your 3-year visible revenues metric? Based on your reporting, it's unclear what qualifies for inclusion in the metric. According to the footnote on page 1 of the 2024 annual report, visible revenues are either 1, contracted, 2, anticipated, or 3, based on historical run rates. From an investor perspective, it is difficult to make an estimation regarding the likelihood of these revenues materializing, given that 2 and 3 above are inherently subjective. A case in point is here is the contract awarded by the Borough of Hackney, announced on 16th September 24. As per the RNS, the 12 million had been included. The 12 million contract value had been included in 3-year visible revenue as at March 24. If the contract was only awarded in September, what gave management the conviction to include it in the 3-year visible revenues at March 24?
Me or you?
Do you want to start off on
the
metrics and the explanation?
Yeah, I mean, so what we said this, and we've been pretty clear. This is not an order book, so there is a level of subjectivity around this, as the question illustrates there. But what it is based around is A, contract values, B, expected run rates around that, and more sort of generally sort of any other knowledge or elements that we have that give us a good visibility, in inverted commas, as it's stated in the definition of what the revenues are going to be. So we use that, and partly why we don't use an order book as well is because a lot of our contracts, and Lee kind of referenced this earlier on in terms of the win that we have on Newham, and I use that as a sort of a slight example of what we see. So Newham started off as like an 80k per annum, I think it is, and in the first instance we would have that as our revenue, visible revenue, because that's the underlying contract value that's there. in the absence of anything else, it's a new client. We don't have any track record or historical knowledge of what that will be. As that builds up, the underlying contract might still say 80k. As Lee indicated, we've already got additional properties that we're going to be using. So that will gradually, as we get that better visibility on that underlying contract, which might only have a minimal, sort of testing kind of value put to it, we will build that up as our knowledge builds up and we have a better track record of that. So we will include that in it. And that's why we talk about it being visible, because it's our best estimate of our look forward. If we were using a strict order book number, it would be significantly lower, but would be significantly understating what our expectations would be. In terms of the specific Hackney contract, which has come up a lot in this call, we've known for some period of time. I think Lee outlined that as to that process that we went through. So, and we were expecting that contract to have been completed from the beginning of April. From a legal perspective and a process, we wanted to make sure, and on the flip side, Hackney needed to make sure, and their lawyers needed to be comfortable, we had the robust wording in place that actually make sure that we are fulfilling what the original terms that we'd discussed with Hackney, which was the 12 million, were in place. So back in when we did in July on the final results, the Hackney element, that was well in progress at that stage. We had a very strong expectation, and it was therefore visible to us that it would be 12 million. We knew that was the case. It's just the timing of actually the sign, sealing and delivering of it took longer than we expected.
And hence then, Clive, obviously the lag between that and the announcement, because clearly, it is, it is only right for us to announce the market once we have signed, sealed signatures in hand as part of that lag. So hopefully that answers that question. There's another question here. With regulation and regeneration accounting for 90% of total revenues, are there plans to diversify revenue streams, or is the focus on strengthening these pillars? If we dial back, there's the three strategic pillars: regulation, regeneration, and renewables. We've highlighted quite a lot of work here in terms of in its nascency on that social housing decarb fund element. That will all fill that renewables pillar. So we expect obviously elements of those to balance out from an ongoing perspective. Regulation will always remain the core. We expect obviously the pie to increase, but certainly the lagging element with renewables we should see and will see addressed in terms of that balance in relatively short order. What I should emphasize is obviously the diversity in terms of these the pillars. Regulation, regeneration, renewables by default covers each of our service divisions from a mechanical, electrical and building services element. So there is diversity within there. We continue to remain consistent on capturing the two sector drivers, compliance, decarb. From a business perspective, the three strategic pillars of regulation, regeneration, and renewables, and within that are three core service offerings in terms of mechanical, electrical, and building services. We'll continue to broaden and deepen each of these elements, but we remain focused on that priority. Hopefully that answered that question. What is the outlook without an increase in government spending is one question that's come in. I've emphasized this time and time again. We are fortunate that we are an essential service. Effectively, in terms of what we offer and what we provide, which is the fundamental requirements of someone in a property and or a tenant, is to be safe and warm. So we deal with non-discretionary revenues because it's compliance driven, as we've mentioned, the underlier on regulation. So regardless of outlook and government spending, and they will spend, be in no question about it, in terms of the implications, all these taxation elements within the budget is going somewhere, and historically has demonstrated that strength in social housing. There will be money there, and it will get spent. Regardless, within the environment that we have, we set as a priority, because again, if there is limited budgets, one thing that a landlord will not do is jeopardize the safety of their clients. So we sit in that non-discretionary piece.
I think on that as well, David, you know, the news from this morning of the Wave 3 fund bidders at 2.2 billion is further evidence that, you know, the work to be undertaken is there, and the opportunity will follow that. You know, so that's evidence again this morning to keep people safe and warm.
Another question here. Good morning. Thank you for the continued hard work you're putting in. Thank you very much on behalf of the board. We have seen movement in payables of minus 2.7 million, of which 1.3 is the HMRC payments. Please elaborate the difference of the 1.4.
I was just having a quick look at that actually in terms of that. So yeah, 1.3 is, I mean, partly it's just timing differences between the period ends. So I think that's movement from the end of March to the end of September. So actually, just looking at that, we've just seen sort of smaller amount of changes on that in terms of some movements in accruals. Trade payables have gone up, I think slightly, representing a bit of that movement, and the balance is actually that although the HMRC payments were 1.3, it's actually moved about 1.8 million in the period. So I think that most of the balance of the rest is kind of like on just really a timing differences in terms of the differences between the period end. The end of March is obviously the end of our most busy quarter, so I think it really just generates some timing differences into the balance sheet movements.
Thank you, Clive. Question here: building services margins have reduced. Please provide some colour on the reasons. So there's an element, obviously, in terms of the building services per se have reduced. It is obviously the driver being that Hackney gap, because that's part and parcel of that dominant factor in terms of that Hackney gap. Now, with respect to the potential contribution in terms of part of the margins was, as we've mentioned, we were in that transitioning perspective on Hackney. We ensured obviously that we retain the staff as part of that transition process whilst there was that lag coming into play. So that is one element of that. The other element will be on the Durham side, with us starting to pick up momentum. Obviously, we want to be ahead of the curve, therefore putting investment as part of that front end piece, which again I highlighted as part of that headcount element earlier in the presentation, will also have an impact in terms of those margins. But we expect those to come back a little bit once obviously the workflows start moving in earnest. Hopefully that answers that question. There's a question here: are you still planning to achieve 69 million of revenue as guided at FY26 results? Well, hopefully we're planning to achieve more than that. That's obviously the objective is for us to maximize the direction of travel. And as I mentioned earlier, we sit in a good place. I think the only thing I can refer to with respect to answering that question is that I believe the analyst note has circa 71 million in terms of revs for FY25 full year. Finally, how do you envisage the soft marketing strategy of attending events with local authorities contributing to the achievement of future business goals? So in terms of soft marketing strategy of attending events, I mean, we'll always attend events that have a purpose. We won't just attend an event for the sake of attending events. So that's the first thing that's important to emphasize. There'll be an underlying reason and rationale for doing that. With respect to the softer markets, I don't know whether this was sort of alluding to Lee from some of the social value elements. I mean, social value is part of our culture. and it starts internally and of course has a focus externally as well in terms of supporting the local communities. I think that I can only come back in terms of some of these events and that element of social value that Lee alluded to is the importance that this is being recognised in terms of local authorities and a requirement as part of that tendering process, actually, that there is commitment to social value. Therefore, by default, as a business, our involvement with that and that exposure and opportunity to network with a broader community within our clients, by default, is always good for the business. Any business where you're reliant on an individual within another business is a fragile and dangerous game. For us as a business, we want to be partners. We want to get involved with our partners and therefore interacting at multiple levels, which by default will benefit and help to safeguard that relationship as part and parcel of that. That's the last question. Hopefully that was answered as well.
Absolutely, David, Clively, if I may just jump back in there, and thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this morning. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses where appropriate. But David, perhaps really just looking to redirect those now on the call to provide you with their feedback, which I know is particularly important to yourself and the company. If I could please just ask you for a few closing comments just to wrap up with, that'd be great.
Absolutely. Thank you very much. So thank you all for tuning in today and joining in as well as the questions asked. Hopefully you found the presentation productive and positive in terms of its perspective. From an organisation position and on behalf of the board, we are very confident in terms of where we are. DCB is at an end. We are now on that forward journey. With respect to that forward journey, we are now in a position where we will start to see inflows of cash into the business, and the true strength and demonstration of the cash generative qualities of this business will still start to come through and be evident. And with that, therefore, a prioritisation from us as a board to focus on capital allocation and maximising that return for our shareholders. We've announced to the market in terms of our direction of travel. We've announced a moderate upgrade, and as we move into the heavier end of the full year, we're confident in terms of our outlook and delivery. Thank you very much for attending, and we all wish you a good day. Thank you very much.
Perfect, David. That's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of KINOVO PLC, we would like to thank you for attending today's presentation. That now concludes today's session. So good morning to you all.